Our first talk today is with a guest that really doesn't need a whole lot of introduction because most people have heard or read Michael Maubousin's research. I would say that kind of after Buffett and Munger and sort of this current guard of the highest, most respected investment writers, when you ask around, it quickly coalesces on Michael's work as sort of the person that will take that banner as the most prolific and interesting investment writer. He's basically tackled all of the big questions that we have, from moats now to bonds to everything, including competitive advantage, and done it in an incredibly detailed and systematic way. So we're going to cover a lot of that stuff. I would highly encourage you, we're going to give a longer than normal buffer at the end of this talk for your questions, and those come in via that text line. So about 20 minutes into this, I'll ask some prepared questions, but please, anything you've got for Michael, start sending in now, and we'll take those questions via iPad in about 20 or 25 minutes. So send those in and join me in welcoming Michael Mauboussin. Michael, so you and I have done this a fair amount, and talked
not quite as comfortable as
yes,
this.
and talked about everything under the sun, and so I want to really spend some detailed time on some of the most interesting concepts that you've explored in investing. And as we do this, again, if you want more detail, please submit your questions. I want to start with moats. This has come up a few times now. It will come up more in today's presentations. I think everyone is interested, both personally and in their businesses or in their investing businesses, at building a sustaining, hopefully growing competitive advantage. And the question I have for you is how much your views on this have evolved over the years. So when you first started studying this, Michael Porter's been mentioned a few times. There are a couple other interesting frameworks for thinking about competitive advantage. I want to do it on the business side and on the personal side. Let's start with business. What have you changed the most, if anything, over the years, in your view?
It's a great question, and the first time I wrote about this was in 2002, so 17 years ago. And it was probably the first or second hardest thing I've ever written, personally, because it felt like an enormous amount of synthesis of a lot of different research, including Porter. I thought Dan's comments yesterday morning were super provocative about the inability of these things to predict things, five forces. I should say I teach, of course, things about strategy in my course at Columbia Business School. And this year I handed him a copy of Dan's article and saying, like, okay, here's the other side of this. And I do think the strategy world, it feels a little bit like what's going on in psychology, where there's a little bit of a replication crisis, and we don't really know how much of this stuff is just these interesting ideas versus what works. But I guess when I think about it, there are a few things that I think we do know. One is we do know what return on capital patterns look like for different industries and companies. And we've got a fair bit of empirical data on that, and that's a good starting point. I guess I should take one step back and say, what is a moat, right? And I think that the ultimate quantitative reflection is just return on capital, right? Return on invested capital. So we know what those patterns look like. The second thing, which I think, when you think about the five forces, one of the big ones is barriers to entry. And in fact, if you talk to Bruce Greenwald at Columbia Business School, he thinks barriers to entry are basically all that matter. We have a lot of entry and exit data. And I think that tends to be underutilized by a lot of investors. Just how much entry and exit has there been in this particular industry? And I love to show this to my students. I show them the entry-exit data for the hedge fund industry. So if you want to go be a hedge fund investor, just realize how many people are coming and going and how easy or hard it is to do that. And then the third thing we know is there was a really interesting thread of research by a guy named Michael Rayner. Rayner is now a consultant at Deloitte, but he got his PhD with Clay Christensen at Harvard Business School. And he worked with a statistician to try to understand corporate performance in general. And the way they ran the models, they just looked at a transition matrix. You don't have to know the details of this, a transition matrix, but they understood that they figured out the empirical parameters for the last 50 years or so. And then they simulated like 10,000 universes. And they asked the question, how much of corporate performance writ large is a function of common cause variation, which is like what you expect from the system, and how much is special cause variation? So you might call that luck or call that skill. And they found that, in fact, a small percentage of companies definitely were skillful. And by the way, it's not a very dissimilar thing to money managers. Money management is really hard. It's a lot of randomness. But we know that some managers do exhibit persistent performance. It's just hard to know who's going to do that a priori, right? So I think those are things that I think we have a pretty good understanding of. I'll just mention a couple other things that are really worth emphasizing. The first is it's very important to recognize that strategy, like a lot of other things, is probabilistic. And when you introduce a strategy or embrace a strategy, there are a bunch of things that can change that you can't anticipate. One, your competitors may do things you're not thinking about. Your customers may demand things or not demand things that you think about. And technology itself can change out from underneath you. So I think there have been a lot of actually probably really smart strategies that have failed just because of bad luck, and some probably not so great strategies that have worked because of good luck. And the last thing I can't help mentioning, and I think it's a big deal even when you have venues like this, is it's really, really important to be mindful of survivorship bias. We tend to tell the stories of the winners, and we tend not to tell the stories of the losers, and often the stories of the winners and losers are not that dissimilar from one another. Yeah. And there's an academic I love on this, a guy named Yerker Denrell, and Denrell's talked a lot about, we're underrepresenting failure in a lot of what we do. And so what I've learned is that we're still, and by the way, the Holy Grail, I think, and something I'd still like to really work on, is if ROIC is the manifestation of moats, or how we think about moats, is really, can we start to do a really intelligent, more systematic or quantitative mapping from the drivers to those ROICs. And so whether it's Porter or some other kind of language, how do we get at it?
To Dan's point yesterday about maybe moats and five forces are not all that useful from a predictive standpoint, do you think that it would be fair to say this is all still worth studying, but probably more as an operator, as a business person, than as an investor? Because maybe the problem is these are the key ingredients that drive success, but they're well thoughtfully priced by markets. So there's not an edge in identifying a moat necessarily, but there's an edge in understanding moats as a business person to run your business better.
But I do think it's both. I mean, they're probably opposite sides of the same coin, and it is interesting to ask. You say, like, basically, what leads to crazy good total shareholder returns over time? Yeah. And it's usually two things. One is people had low expectations about the business, as you point out, and that may manifest in a low valuation. But second is there was a decent business that tended to outrun people's expectations for excess returns or moats. So it's usually a combination of cheap valuation to begin and pretty good business, and that's what leads to the sort of gargantuan returns. The other thing I'll just say, going back to like what's new, and I think we'll talk about this later this afternoon, is in the mid-1990s, I was exposed to a lot of work by Brian Arthur and others on the notion of increasing returns and network effects. And so I learned that stuff, internalized a lot of that stuff in the late 1990s. And even though I wrote about that even in the 2000s, I think that the notion of the power of networks and platforms has become as bigger than I would have ever imagined. One
thing I've never asked you about in this category is how some of these same concepts apply at the personal level, and maybe generally personal, but maybe career most specifically. One very interesting thing you've done for so long is teach students, yeah. And I know your coursework has evolved. How much do you think we can port over competitive advantage to the personal and career level? And if so, what advice would you offer to people?
It's a really interesting question. So I'll answer this a little bit with my sample of one based on me. I was a liberal arts major in college and had no business experience or anything like that. So I went to Wall Street, and I was very lucky to join a training program at Drexel Burnham Lambert, which at the time was when Mike Milken was sort of at his peak prominence. And this training program was really cool because what we did is a bunch of classroom stuff, which helped remediate guys like me to get up to speed on accounting and finance and so forth. But the next year or so, we just rotated through 20 different departments in the firm, from operations to all the trading desks to research to investment banking. So basically, you got to look at every single facet of an investment bank. And for me, that was phenomenal because I could figure out right away what I enjoyed, what I liked, what I was good at, and what I was bad at, and what I didn't enjoy. And David Epstein, who's got a book coming out this week called Range. It's fantastic, and I'd highly recommend it.
He'll actually, as a side note, he'll be the podcast guest next week when it comes out.
Okay, great. Oh, so we'll know the clue. We don't need a clue now. We know the answer to that. That's great, and I'm sure it's going to be great. But he's got a section in his book where he talks about this idea of matching. And I think this is where the competitive advantage thing comes in, which is what you really want to do is sort of match your daily activities to the things that you feel like you're good at and things you enjoy doing. And there's this idea like sort of you're in your genius zone, you're doing what you're really good at. So to me, that would be That's probably the strongest advice, is just trying to match those things up. And usually where people go wrong is they're doing things that they shouldn't be doing. I should, as a sort of end to that Drexel Burnham story, that job led to me to be, I guess we call them brokers, but now I think we call them financial advisors, to be a broker, basically, at Drexel Burnham, which had a big retail business at the time. And I did that for about a year, and I was a complete abject failure at it. And I just remember one day calling my wife, my girlfriend at the time, my wife, and I'm like, I'd rather ride the subway back and forth all day than go to work. I was like, that's probably not a good sign. I'm probably not doing the right thing. But that was that failure and that lack of enjoyment and lack of capability and lack of success was a big imprint on me as well. Let's go figure out what I can do. And so the other thing I'll just say in an investing context, and I think everybody here in this room probably gets this, but I think one of the big issues in investing and why people sometimes don't do as well as they could is there are a wide range of strategies that probably allow you to do well, from, let's call it, Jim Simons at Renaissance Technology, trading all the time, to Warren Buffett, right, and everything in between. And the key is just to have your process be congruent with what you're trying to do. So really understand what you're trying to do and make your process congruent. And I think one of my observations in many years of doing this is many people sort of think that they're doing one thing, but if you watch, you kind of roll back the curtains and see what they're doing all day, they're not congruent with what they're ultimately trying to do. So that's another thing I would just say, is that the degree to which you can be congruent in what you're trying to achieve and your actually day-to-day activities, that's a really powerful, positive thing. And then when it goes off the rails, it's usually not doing that.
One of the things we've talked a lot about is your passion for the pairing of learning and teaching, and the importance of how those two things work together. Again, kind of thinking about your students and the way your curriculum has evolved over the years. Talk about why both of those are important, and maybe one without the other would be far less valuable.
I think you and I share this, and again, this comes with I'm not saying this is better than anything else, but this is sort of what works for me, is that I'm not a super smart guy, but I'm kind of a curious guy, and I'm like a tortoise. I'll just keep plodding away at things for a long time, until I think I can understand them. So what I found to be the most enjoyable thing is figuring out something that's, an area that's interesting, and just being curious about it and just trying to learn a lot about it. But I find that I really can't claim to have consolidated any of that knowledge until I can do one or two, or ideally both, of two things, which is write about it or teach it. And usually they go together, right? And I found that some of these things I found the hard way, because you stand in front of 65 smart MBAs and say something that you don't know you're talking about, you'll find out pretty quickly that you don't know you're talking about it. So try to stay one step ahead of them was really very motivating. And I do find, and again, I worry a lot that this output part, the writing and the teaching, is too ego-driven, but I worry about that. But I think it's really the balance of both those things that makes me feel most fulfilled. And writing a book is an interesting process, because writing, you're doing all this. You're doing the inputting, you're doing the learning, and you're trying to, and then once the book is out, it becomes a lot of outputting, and I feel like I'm a little bit out of balance when I do either extreme of those things. So that's why writing reports periodically, feels like a good balance. And that's what I would just say. I usually say to young people, if that's the kind of thing that appeals to you, you should be a lifelong learner, and that's what you do. So, I had a daughter just graduated from college on Saturday, and I was like, give her a hug. I'm like, congratulations, this is great. And I'm like, tomorrow's the first day of your education.
Yep.
Right? And get after it, right? Start finding out what you're going to read, thinking who you're going to talk to, and your education just begins right now. And that's the attitude I think you want to have.
I like the combination of those last two answers, and I'm curious how your curriculum has evolved. So
you've asked me that 3 times already.
You're teaching the literal set of topics, obviously over several decades now, to smart MBA Columbia students, has changed, I know. So maybe talk about what you've added most recently,
definitely.
as in terms of what you've learned.
I'll say a couple things. First of all, I teach, this is a course that Ben Graham started teaching in 1928. And a lot of people have taught it, but I take that very, very seriously. And I think to myself, if Ben Graham were sitting in the front row, would he think this is where this whole thing should be going? And I'm very serious about that every time I do that. So the biggest thing I've added in the last 15, 20 years is a whole module on decision making. And many of you may have been, when I went to college, there was no behavioral finance or behavioral psychology. It didn't exist. If you took psychology, it was some developmental psychology or abnormal psychology. It was nothing like decision-making related stuff. And even when I started Columbia Business School, there were no behavioral finance courses. And I encouraged the students to take negotiations courses, in part to be able to understand other people's points of views and sort of tap into some of these concepts. So probably, 20 years ago, I started to realize what separates good and great investors is not that their DCF model's better or their cost of capital goes out another digit. It's that they know how to make good decisions, especially under some sort of stress. And there's a whole framework for thinking about good decisions and a whole process around that. So I spent a lot of time now, that's a big chunk of the course, is teaching people not only here are all these tools, and these are the prerequisites to be able to play the game, but really what I want you to do is think about how you're thinking and create processes that you weave into, or procedures that weave into your process to allow you to make good quality decisions. So that was a really big one. Another thing I just added in recent years is, this is a typical professor thing. I pontificate about, the most important thing for assessing a manager's capital allocation. And then I read Will Thorndike's book, and I'm like, all right, that's really good. Like, I should probably get serious about this. And then then we did a study of how the top 1,500 companies in the U.S. have spent all their money since 1980. So now we have a good sense for how capital's been allocated and how to think about it from an academic point of view and a practical point of view and an incentives point of view. And so now giving, again, a much better framework around that. And then just the strategy stuff. I mean, the core DCF stuff's not changed at all. And maybe the last thing I'll say, and we might get into this if we talk about Santa Fe stuff, is that if you go to standard business school, you're typically taught efficient markets. And I don't think professors believe in efficient markets anymore. But, and I don't think it's a bad thing to teach, by the way. I think it's actually an important thing for people to understand as a touchstone for how the world works. But my thinking very quickly has evolved to think about markets as complex adaptive systems. And once you get out of this sort of efficient, rational agent framework into complex adaptive systems, it opens up a whole world to you and allows you to understand why markets are hard to beat, which is obviously true, but also why they go periodically haywire, which is also true. So that has come with it a whole sets of tools and ways of thinking about the world that I think have been incredibly informative. So now so what I do with the students is I actually walk them through models of market efficiency, from mean variance efficiency and rational agents to absence of arbitrage, which is probably where most finance professors hang their hat, to the notion of complex adaptive systems, and say, I want you to be on familiar territory as I walk you through where I think the world is going. And the other thing that's interesting about complex adaptive systems, I mean, Andrew Lowe's new book, Adaptive Market Hypothesis, maybe being the exception, most of that whole work has not been led by economists. It's been led by biologists or computer scientists or other fields, which is super interesting. So that just argues for this, transdisciplinary approach.
So I was going to ask about, we'll come back to some of the decision-making stuff that really resonates with your students, because there's so many biases, right? You can look up biases, there's like hundreds of these things, It's like factors. So we'll come back to that, but since you mentioned it, I think this idea of complex adaptive systems is kind of like you described to me with a couple other things you've investigated, so moats, capital allocation, where you were talking about it and then you sat back and realized, this is kind of complicated. Maybe I should actually write about this and make sure I understand it. Maybe we could do that for complex adaptive systems. It's one of those terms that sounds fancy and makes you sound smart, but I think maybe few have ever really gone as deep as you have, especially with your work at the Santa Fe Institute. So describe Santa Fe and describe complex adaptive systems.
Well, at Santa Fe, just a quick and very quick mention of Santa Fe Institute it's out in Santa Fe, New Mexico, to state the obvious. By the way, its proximity to Los Alamos is not a coincidence. It was many of the leading, mostly physicists from Los Alamos coming down to Santa Fe. And I think the founding fathers, and I've been rereading some of the original documents from it was founded in '84. They said academia is awesome, but it's too siloed. So the economists talked to the economists and the biologists talked about it. But actually, most of the interesting problems in the world are at the intersections of disciplines. So they set it up as a non-degree conferring institute where it's transdisciplinary. And the reason I love going there, not only the ideas, but also the fact that people are self-selected to be interested and curious in a lot of things. So it's super fun. By the way, as one example of that, I went to sometimes I try to go out there for a week or two in the summer, and I went out there and I'm sitting, and so the big things, there's tea every day and there's lunch, big convening power. But another side note, I was recruiting our president, and he introduces me to this guy named Rogers Hollingsworth. We ever talk about this?
No.
So he's like, Rogers really wants to meet you. So I go sit down with this guy, and I go, he's a guy that studied creativity and scientific creativity in particular. So I said to him, and he's like in his 80s, I go, Professor Hollingsworth, is there any key to creativity? He goes, yeah, lunch. It's like, lunch. I eat lunch, does that help me? No, he's like, what? He goes, all the great scientific institutes have all the scientists eat lunch together every day. And the reason is there's this sort of serendipitous exchange that allows these guys to solve problems in a way that if they were just sitting in their offices, they couldn't do. So that's why we have lunch and we have tea, and you have these incredible. So I'm sitting down to lunch one day, and there's a raging debate about whether a horse could beat a human in a marathon. So I'm like, only here do I come debate horses and humans. So complex adaptive system has typically 3 components to it. Markets are a great example, but you can have many others you could imagine. Neurons in your brain, or cells in your immune system, or ants in an ant colony. So you have these, the first layer is just individual agents, investors in a market. The second key component is they interact with one another. Now, markets, those are exchanges. For ants, those are pheromone trails, signals in your immune system and so forth, synaptic connections in your brain. And then the final thing is there's a global system that emerges from that interaction. And the key that's really important to understand and hard to understand is that the whole is not equal to the sum of the parts. The nature of the system changes as this emergent phenomenon occurs. So additivity doesn't work. So in much of science, we've made incredible strides in 400 years through reductionism by breaking things down to their pieces and adding them back together. And in complex adaptive systems, reductionism doesn't work, which is why it's so flummoxing to understand it. So there is no additivity. So, by the way, Phil Anderson, Nobel Prize-winning physicist, wrote a great paper in 1973 called More is Different. And his argument was when you go up these layers of a complex adaptive system, the global system is different than the individual components. So why is that important? Well, there are conditions under which that complex adaptive system will yield very efficient results. And we'll talk about markets, right, specifically. But that's why ant colonies, like social insects, are so fascinating to study. Bees or ants, whatever. They've been at this for 100 million years. And they've solved some incredibly hard problems through evolution, right? Because the optimal solution gets weeded out by definition. So cool, right? So what are the conditions that usually we talk about? Diversity, so you need heterogeneous agents. We need different types of cells, different type of neurons, different type of investors. We need an aggregation mechanism. So all the information in the world is great, but unless it's aggregated somehow, it's not valuable. So we need pheromone trails, we need synaptic connections, we need prices. And then the last thing is incentives, which are basically rewards for being, it's a way of keeping score. Rewards for being right and penalties for being wrong. In markets, it's money. It doesn't have to be. It could be your reputation. It could be fitness for a species would be another measure. So when those 3 things are happening, you tend to get very efficient results. When one or more of those things are somehow violated, you get inefficient results. And in markets, obviously, the most likely thing is rather than us being independent or diverse, we correlate our beliefs. And investing is inherently social, right? We're social beings. So we like to be part of the group. And so as a consequence, we often will correlate our beliefs. And even if you don't believe, I mean, Josh showed that amazing thing from the Ash experiment yesterday. That's exactly the mechanism. Is you're like, that guy was an idiot. They answered, they're all idiots. I'm going to answer the right answer. But the 3rd or 4th time, you're like,
am I the idiot?
This doesn't feel so good being part of the out group.
Yeah.
And that's the thing, like investors, you have to be, like many of the skills of being a great investor are not skills that make you a good person.
Yeah.
Right? So it's an interesting, weird thing, right? So that to me is the framework. And so then you start to say, how do we measure things like diversity? And those are super interesting questions about, things like, we use terms like crowdedness and other things, but these are sort of proxies for what we're after, which is we've correlated our beliefs. And a lot of the best models for this are actually probably epidemiology models. So it's how ideas spread might be more like over a network, might be more how diseases spread over a network, something like that, which is super cool, right?
I think back to yesterday about the 94% consensus that private equity is going to outperform everything else. Do you think that one of the key lessons, and what are the other key lessons from your work with complex adaptive systems for markets, is really just that the best opportunities will come at those diversity breakdowns?
Definitely.
I think that's one source. Are there any other sources that, having studied this kind of multidisciplinary take on it, you would encourage investors to think
No,
about?
but I think that's probably the big one, which is just when you have, I mean, I've repeated this many times. If you ever read my stuff, you've seen me write this a zillion times. This line I love from Seth Klarman where he says, value investing is at its core the marriage of a contrarian streak and a calculator. And the contrarian streak says when everyone believes one thing, so 94% believe that private equity is where I should invest my money, I want to examine the other side of the case. But the calculator says, because if everybody believes this thing, that means it's a mispriced security or mispriced asset class. So it's really the combination of, so you don't want to be a contrarian for the sake of contrarian, right? When the tornado alarms go off, go into the shelter, don't run out of the shelter. That's a Columbus, Missouri customized comment.
We tried to make lessons in all week long.
But being a contrarian is really important, and that's the thing that comes back to it. So a lot of this is temperament, and that's why I'm saying, like, when people buy things that are not traditional, you just have to not care that other people don't believe what you believe. The other thing I'll just say about the private equity thing, that this one, and I mentioned it to Dan when we talked a little bit afterwards, there is another component to this which seems ridiculous, but I do think one of the keys to private equity returns has been literally the fact that people can't access their capital. And in public markets, people tend to be much too skittish. They tend to move managers around too much, and that just creates a huge drag on their performance. I think that's been demonstrated many different times. So part of it is just the fact that you don't get marks, and you can't take your money out. You save yourself from yourself, and that's probably a good thing.
What's the most interesting, before we get to a huge list of questions from the audience, so thanks for those, the most interesting thing that you've uncovered or learned at Santa Fe?
Well, the overarching idea of complex adaptive systems is way up there. The idea, I mean, look, a lot of the work on networks, the mathematization of 6 degrees of separation, and all the work we've been doing on networks, much of that work has emanated from the Santa Fe Institute community, starting with Strogatz and Watt's paper, and from there on. So that led to all the stuff on network effects and increasing returns, and I felt like I was early to that understanding because of the folks that I knew there. The last thing, I'm not sure how much practical utility it has, but the other thing I find absolutely wondrous is all the work on scaling of biological systems.
Is amazing.
So Jeffrey West and scale, and for those that are not familiar with this, it's a very simple idea that if you plot, for example, you plot the mass of mammals, so their weight basically, times their metabolic rate on the y-axis, the vertical axis, so how much energy they use. All mammals, let's just say we'll do mammals, from a shrew to a blue whale, they all follow on a straight, and you do it on a logarithmic scale, right? So not 1, 2, 3, 4, 5, but 1, 10, 100, 1,000, so forth. Log scale. It follows a perfect straight line with a 3/4 exponent. And you just look at that and you're like, that's amazing, right? And so it turns out that's been known for a long time. It's called Kleiber's Law. And so what Jeffrey, along with a biologist, Jim Brown, and some others, Brian Enquist is a third, these guys basically figured out why that's true. And by the way, I think what's interesting, that's another area that we may be able to crack. So that, by the way, is it's basically fractals, how energy is dissipated through a network. That's defined by how energy is dissipated through a network. So what we also know in company sizes follow these power laws, and we don't know why. Cities follow these power laws. We don't know why. So the question is, it's a really provocative question, is there something analogous to energy dissipating through a network? And probably the first thing that comes to mind is it would be information dissipating through a network. So how can we codify that? It's super cool. So anyway, I just find that stuff wondrous. I mean, these guys worked out the math, and now you tell Jeffrey anything, like they can predict how long a mammal should sleep, how much, everything. It's just an incredible series of mathematical regularities that fall out of this. And by the way, there is no other way. That's optimized, because nature, like evolutionary forces, kill the things that are suboptimal, and they find the solution that works. Anyway, it's totally cool.
So let's try to bank through as many of these questions. We've got about 20 from the audience. The first is on moats, so kind of an interesting take. Are moats good for society? Aren't they a loss of consumer surplus? What's a socially good moat?
Yeah, it's a good question. I mean, those are, and I haven't thought about that. See, the thing is that it's like all these things, like even like people like fees for mutual funds, if they're too high, is that bad? Well, the people that earn the fees, it's good for them, right? So it may be more of an inequality issue than it is necessarily an aggregate issue. I should say that on this mode thing, and one of the areas, and we've talked a little bit about this, but one of the areas I've been trying to do much more work on and try to understand, and I'm very naive on it, is that we've clearly seen a lot of concentration increases in the United States. So if you plot the number of public companies from 75 to now, it's like this inverted U, right? It peaked in the mid-1990s, and it's been going down steadily. But if you plot the Herfindahl Index, which is a measure of industry concentration, that's followed the exact, it's a U, it's the exact opposite. So the industries are today as consolidated as they've been in a very long time. And the question is, A, does that even correlate with modes? Because I think returns on capital are pretty good in general. And then B, what does that mean for pricing, potential pricing power, right? So I think the standard that's been prevalent for the last probably 30 years or so in antitrust has been this notion of consumer welfare. And I think, the argument against why would you not break up Amazon or not break up Google is because consumers are fine. In fact, they're benefited. I was talking to Ash about this yesterday, and one of the things I always found interesting about Google, when I was at Legg Mason, we were the second largest allocation on the Google IPO. We did a lot of work on Google before it came public. And one of the things was always struck to me was massive consumer surplus using Google, right? Because it's an amazing, I don't know how many times I go to Google every day, but I couldn't do my job without it, for sure, right? And maybe I could use Bing, but it wouldn't be as cool. And then the second thing is, they don't set the price for their product. Just use ads. They don't set the price for their products. It's an auction, and it's a second price auction. Yeah. So can you name any other huge company where there's massive a free service for many people, and you don't set the price for your service? It's pretty cool. So the answer is I don't know. But I think that I'm less concerned about maybe the aggregate, but I am concerned more about the inequality aspects of it, and that's a big issue. But so the antitrust thing I think is an interesting, and there may be political wins that will get people more encouraged. So I've this Jonathan Tepper wrote this book called The Myth of Capitalism. This Timothy Wu wrote this book, I think it's called Big Business. Now Tyler Cowen wrote an opposite book on a love story about big business. So I've read all these different books to try to understand and cobble together that story. But I think that's going to be with us for a long time. This topic and thinking about whether these moats and these strong franchises are actually good for the world or bad for the world.
This next question lines up with David Epstein's work again in his book Range. The question is, how do you look at being an unconstrained investor with regard to something like industry or geography, but still maintaining an analytical or informational edge?
Yeah, I think it would be really hard to get an informational edge doing that, right? Look, I'm torn on this as well. I don't know. I'm going to try to have my cake and eat it too. Bruce Greenwald, my colleague at Columbia Business School, swears that the key to value investing is being a specialist, and it just doesn't sit right with me. And I think the point of David's book, without giving away the punchline, is it is specialist versus generalist. Both have been successful in different conditions, but I think he generally comes down to the fact that being a generalist can be more beneficial. Look, the other thing to say is that no matter if you're an investor, I do think one of the key questions, this actually goes back to the course as well, is like what in investing is immutable and what is mutable? And can you draw that line? Like what is never going to change and what does change over time? And they're probably, if you say what's immutable, the value of a business or value of a financial asset, the present value of cash flows. That's right. A lot of details we need to work out. What's mutable are all these other things about competition and so on and so forth. So if you're unconcerned, to me, so if that you say like, I'm going to use this principle. Now, the reason I'm saying I'm trying to have a cake, the phrase I've always loved the best is 10 years ago, 2009, my teaching assistant was a Navy SEAL. And my wife I had a total bromance with this guy. Well, maybe I had with him. He didn't. I don't know if he had it with me. That's like one-way bromance. And so I'd be like, hey, Josh, can you come to class early? I need to talk to you. We'd like just ask him questions about the SEALs and stuff like that. And but he would say something like, to this effect. He'd say like, every SEAL. I'll tell one story from him. He goes, every SEAL can do every job, but SEALs all specialize in one thing. And his thing, by the way, was Halo. He jumped out of airplanes, basically. Yeah. And he was a very unusual SEAL. He was 6'3" or 6'4", 230. He was an all-American rugby player, so very big for a SEAL. And he's like, I would jump out of these planes in the middle of the night with 200-pound things strapped to me. I was like, what's in there? He's like, ammo and communication equipment. Anyway, very cool. So all SEALs can do all jobs. All SEAls can do all jobs, but they are specialized in one. So the story on that, so he was a jumper. Okay, so it happened to be that spring is when Captain Phillips happened, when the Somali pilots took the boat. As you recall, they had something, and then they called in the Navy SEALs snipers to take out the pirates. So I said, Josh, like I'm really impressed by this stuff. I like all this stuff. I'm like, could a regular SEAL have done that job? And by the way, this guy's a very serious guy, like very, very nice, but very, very, he goes, so he says this completely seriously. He goes, yeah, a SEAL, the bullet would go here for a SEAL, and the sniper puts it here. Glad you're on my side, buddy. So anyway, so I think it's a combination. I mean, there probably is a combination. I would like to say it's very hard to go like that. So it goes back to Buffett core competence. It's very difficult, I think, to be great at energy, great at financials, great at technology, and run around and do all that stuff. I just think that's probably really difficult. The immutable part would be your core sets of skills, but I suspect to be really successful. Almost every investor I know has either gravitated toward or tends to like to do one thing more than other things.
Your story makes me think next year we got to make sure the SEALs that are here with us are participating in the rifle round.
Yeah, exactly.
Make sure everyone sees what's possible.
Guys.
This is kind of an interesting one. So how do you structure aspects of your personal life to allow you to find and explore new ideas, and how do you personally hone the ability to say no?
Yeah, so those are good questions too. I'm actually I'm very lazy, and B, I'm very undisciplined. So I don't know if that's a good thing or a bad thing, but I'm like, but I do think I do if I give myself credit for one thing, it is this notion of curiosity.
Yeah.
So I'm just curious about things. So I will sort of follow threads as you've gathered, and like last year I went on a big kick reading about ancient DNA. It doesn't help my investing career at all, but I was just very interested in how, like all the developments in ancient DNA. So I read like 3 or 4 books about this particular topic. So part of it is just like I'm meandering around trying to figure stuff out. Also, the other thing is I'll say I never don't work in the sense that I'm always reading something. I don't really like. I feel so out of it because I've never seen an episode of Game of Thrones, and it's very embarrassing. So I was talking about how good this season was or whatever, how bad it was. I don't know anything about it, so it's very embarrassing. So that's a trade-off that I have to live with. Not proud of that, but that's true too. So there's no, I'm not sure there's a ton of rhyme or reason. Now, when I'm actually working on a particular project, then I'll really be very serious about collecting information and papers and books and try to read and be as structured as possible in that. Saying no is a tricky thing too. Work-wise, and by the way, the other thing I should say is my wife and I have 5 children. And when they were young, it was really hard to spend a lot of time reading. For those of you that have little kids, you're in the thick of it. And when I was in the peak of it, my wife would literally write a list of things for me to do, and it would be like from 6:30 a.m. hockey game to like dinner with the Joneses, and like every minute was filled out. So all that's gone, which is great. So now my kids are out of the house, and I have a lot more time to read, and that's really a major luxury. For the stuff saying no is, I've actually mostly gone to work and actually asked someone who fields requests, usually professional requests, to say like, let's sort out, let's have a little rules about you do this, don't do this. And so that's usually, I almost like someone else be the bad cop on that kind of stuff. But yeah, those are tricky things. But like I said, I'm pretty lazy. I just sort of like whatever's interesting.
You and I have talked about a lot. We've never talked about this. Someone asked, does culture beat strategy? So
yeah, that's a good question. I mean, I don't know the answer to that, but I mean, the ideal would be to have both, right? And the first thing that comes to my mind is actually something we were just talking a few minutes ago, which is like professional sports. You could ask Sam this later on, like if you're a professional, it's probably both, right? And maybe they go together. I don't know, but it feels to me like culture is a really important thing. So maybe I would say culture over, but I think a great culture is going to have a good strategy. Probably great cultures rarely have idiotic strategies.
Yeah.
Well, maybe like Jonestown drink Kool-Aid or something. It's good culture. Yeah, so I probably pick culture. And that's the thing I've always found fascinating, which is, and this is an interesting open question, which is, these great sports franchises, like the Patriots, whether you love them or hate them, and it's fine to do either, it's an incredible system. And what's so amazing about that system is people come in and out of it, but the system itself not only remains intact, it actually probably improves over time. Now, part of that's by dint of a single guy, maybe, or a couple people, but that's a remarkable thing. So we'll call that culture, and I think when people come in, they buy into what's going on, right, which is a big deal.
Curious your take on the application of just quantitative, more systematic processes broadly in investing, whether will still be increasing or high returns on that sort of style into the future, or if you think a lot of that's been eaten up. Maybe an interesting side pocket question to this would be your interest in statistics in lacrosse.
Yeah.
So this is obviously a sport that's way, the money is not there probably to inspire a ton of people to be lacrosse statisticians. But maybe what has been your exploration there about the returns on stats and quant in something that really hasn't been touched by?
Well, the first question you can answer more intelligently than I can. I think it's a really interesting. I mean, and look, I'm very inclined to be more quantitative, and I do think that even in what I find so hard still to understand is that the discretionary investor world and the quantitative investor world seem like completely different tribes, and I've not really seen anybody be able to bring these things together personally very effectively. So I grew up as a discretionary investor. I basically teach discretionary investing, but I'm very I have a lot of affinity for the quantitative type of stuff. Probably the thing that's the closest to it, to me, that is palatable for the discretionary folks is this idea of just using base rates all the time. Dan mentioned it yesterday, but I don't know how you have a conversation, an intelligent conversation, or build an intelligent model, or look at an asset class without really having investigated deeply and thought carefully about base rates. And base rates also, if you're thoughtful about it, will lead you immediately into understanding not only that regression to the mean happens, which we all know, but the rate at which it happens. So there are all these other ancillary benefits. So to me, the base rate is a good example of how you do. So I think we need to have. And by the way, the other thing is that we're off the record, right? So the systematic, we had a big systematic team. 30 folks, and a lot of PhDs, and they're great. I mean, I love hanging out with those guys. They're scientists. They're a lot of nerds. It's great. And so one guy one day sends me an email. This year sends me an email. So this is one of our top quants, right? And he sends me an email. He says, "Can you recommend any books about how to value a company? I've never valued a company before." I was like, that is awesome. So here we are, like pushing around billions of dollars. And the guy's like, I don't know how to value a business. And he's completely honest about it. He's like, so I'm like, here are 3 things. He's like, thanks, dude, that's great. So I was like, all right, like there's got to be some middle ground between like, anyway, so, well, lacrosse is just, and I played, I'm just a big sport. I love sports. I do watch a lot of sports. I don't watch other series, but I do watch sports. I grew up playing soccer, ice hockey, lacrosse. I play ice hockey now still. I played lacrosse in college. And so it was actually a Santa Fe Institute event we did it was right when Moneyball came out. We decided to do sports as a complex adaptive system, which was really a stretch of a title. It was mostly sports analytics stuff. And we had Paul DePodesta, who was with the Oakland A's at the time. It was an interesting, who actually may have been at the Dodgers at the time. But one of the guys we had speak was Dean Oliver, who wrote a book called Basketball on Paper. And it was like the first book I'd seen really about codifying how basketball works. And he said, so I read this thing, I'm like, this is basically lacrosse. It's the same thing. It's possession and possession efficiency. Now, in lacrosse, you can test every possession after a score with a face-off, but basically it's the same concept. So I was like, this is pretty cool to map these things over. And so that's been fun. I do this sort of I'll be spending a lot of time on that this weekend, working on the final statistics for the 2019 season. But it's a super fun thing to get, and most lacrosse players and coaches are not super bright people. I was one of them. So they're not thinking like, when you say like standard deviation or partial win, they don't really know what that means. But you can communicate the basic ideas in a way that can be pretty fun. So it's been super fun. And it turns out that I want to be super clear, I take no credit for this whatsoever. But the 2 teams I spent the most time with in the off season were Penn State and Virginia, and they're in the Final 4 out of 70 teams. So that's pretty cool. So they're probably finding me because they're already good versus the other way around, but that's pretty cool.
I remember in terms of quantitative plus qualitative, I remember when I first talked to Sam Hickey, who we'll hear from later, he said, someone had asked him a question, well, if you're flying an airplane, like, do you want the autopilot, do you want the systems handling or the pilot? And he's like, well, both. Like,
exactly.
Like whatever's right in the right situation. Like.
Yeah, and I think that obviously this whole theme of man plus machine does still make the most sense, and you have to. Yeah, but look, right, we're always fearful, and there's just great work on algorithm aversion. We don't like to hand things over that we've been doing before, but for certain tasks, for sure, and even within investing, certain tasks.
So just to come full circle with the last question, your portion of your course that's on decision making, I would love the things that have resonated most with the students, and maybe your favorite mini lessons within that new category, because ultimately, like, one of the goals here is you leave here, you've thought about something a little different, maybe you make better decisions or look at something different into the future. So what have been sort of the weightiest of those ideas?
They're kind of probably two things. I mean, I'm speaking on behalf of my students, so they may not agree with this, but I think there are two things. One is, the first thing is, I wrote a piece about this, and it was called Decision Making for Investors. This is many years ago, but what I decided to do was to say, I'm going to look at people who make decisions in probabilistic fields. So forget about investing, but I'm going to look at poker players and sports team executives and, you know, gamblers of all sizes. Like, what do they have in common? And look at those common themes. And there are a couple things that they usually focus on. You know, they always think about having some sort of edge. They're very focused on time horizons. They focus mostly on process versus outcome. So they're like these common threads. So just indicating to students, look, if you're going to do this, it's a probabilistic field. We know, and so I ended up calling this the T theory. That's what they remember. So the T theory says the best in each of these fields have more in common with one another than they do with the average person in their field. So Warren Buffett has more in common with Annie Duke or some other, you know, or Sam Hinkie than he does with the average investor, because those people across the top are using these same sets of disciplines. So that's the first thing, is just to say there's a way to think about this in a way that's better than other people tend to think about it. And then the second thing is actually really specific sets of tools. So when you walk away, you can do things differently. And the ones we usually, again, it's application to the base rates. So be very methodical about that. It's the notion of pre-mortems. Everyone here has probably heard of pre-mortems, but you should be doing them. They're cheap, they're quick, they're easy. Go do it. And then red team, blue team, to the degree you can. And then decision journals, and that's just the big one, is just making sure you're documenting your decisions, writing it down in an effort to give yourself honest, credible, and direct feedback.
What's amazing is that how much of this is just behavioral. Like, the things themselves are not that hard to do.
Simple.
They're simple.
Piece of paper and pencil.
No one does them. Well, Michael, as always, you know, I could go on for hours with you. I really appreciate you coming and being with us this week, and
It's awesome.
thanks for yet another great conversation.
Great pleasure.